state of the market is not great, I have to say. So sorry to start on such a dour note, but and I'm speaking specifically around kind of unlisted private market investing. Um, so that I would distinguish that from kind of listed equities, fixed income, which is going off extremely well, or relatively well. But on the private market side, it is a challenging time in the market, and the main reason, there's a whole bunch of reasons for that actually. I think it's a confluence of three or four factors that are coming together. One is the fact that because interest rates have stayed persistently high, people a lot of investors are choosing to keep their money in cash or fixed income. So they're saying if I can get 7 to 9% from a fixed income product or 5% through a term deposit or whatever, is the risk premium associated with private market investing actually worth it? So we're seeing that play a big role. I think that there's just overall concern around geopolitical cost of living, the toxication of ESG, all those factors as well are playing into a lot of investors kind of receding from investing in social and environmental causes on the private market side. They're just pulling back. There's a real preference for liquidity, for yield, for low risk, as opposed to taking some of these high risk positions. So that's really what we're seeing. A lot of the venture capital, private equity funds, which are closed-ended, they're illiquid, they're struggling on the fundraising side. So that is very candidly what we're seeing. I will say, however, the foundations who are kind of more genuine, more authentic on the impact side, they kind of see this as an opportunity. They're leaning in. They continue to remain interested, but cautiously interested. So they recognize the high risk that they might be taking by virtue of some of these enterprises facing more challenging conditions. But those capital actors who are more authentic to impact
Yes,
are staying firm. The ones that are kind of more transient, they dip in and out of impact. Those are the ones that we're seeing receding, I think, temporarily from this space on. But on the and Claudia and Siobhan can probably speak more on Claudia, especially on the equity side, but equities continues to be strong. I think this quarter, the first quarter was challenging, but last year was a really strong quarter for equities, and fixed income is going gangbusters right now. Like there is a lot of opportunities in fixed income, especially, and there's an emergence of fixed income managers that are more intentional around incorporating impact. So that's kind of the conversations we've been having with clients, which is how do you still optimize your impact objectives, but perhaps be looking across broader asset classes than just private markets at the moment.
Great. Well, that's great framing. You've already introduced a fair few different asset classes, which is great. For anyone who is at the early stages of their impact investing journey and would like to know what some of these terms mean, there is a glossary on the Impact Investing Hub website where you can look up what all these various things mean, what it means when Neeraj is saying people want more liquidity, fixed income, like all about the different asset classes. Claudia, let's round that out, if you'd be happy to, talking about your perspective on the public markets. And if you've got any thoughts on fixed income, but you're looking at public companies day in, day out. So tell us the state of the market there.
So it's not hugely dissimilar to Neeraj's comments, to be honest with you. As impact is in the listed equities markets, the companies naturally are small. So they're actually not your Commonwealth Banks of Australia or BHPs. And with the Your Future, Your Super, which is the performance benchmark used by the super funds, which means that they get measured upon the performance of the top 300 companies in the stock market, meaning the top biggest, the largest 300 companies in the stock market. It means that there is this capital concentration within those 300 companies. So when we look at our impact universe and we ascertain we've got a proprietary universe where we look at the ASX listed market and we pre-vet companies as defined as impact, as how we define it. And not a lot of them sit in that top 300. So with that, a lot of our companies are valued right now at very cheap valuations because you haven't seen that broader market capital allocation towards that space. So there is a huge amount of opportunity, I think, for people who are a bit long-term, and echoing what Neeraj just said, it's a few factors. It's that your future, your super fund performance test. It's also the interest rate cycle. And I think partly it's cryptocurrency that's pulling in a bit of liquidity, or it's pulling a bit of capital out of the market. Having said that, there is a lot of interest around for people wanting to allocate to an ability to invest in something that's liquid, i.e. you can buy and sell very quickly in listed equities. But we really haven't seen, I would say, the conversion across the main portion of the segment of who we would think would be the target market. And that's a factor of a few things. I think that the Impact Frame Endowments Challenge at the Impact Summit, where foundations are pulling their investment capital and their grant capital together as an impact portion, is really quite at the beginning of that journey for a lot of foundations. And secondly, it's the advisor channel. I mean, I think impact, when I started at North Star 4 years ago, we were still really educating people on what impact was. And we kept on, there was a lot of confusion between impact in ESG and impact and sustainable and responsible investing and all these terms. So through that 4 years, there's the education around what impact is has certainly come up, everyone's come up the curve. So there is an understanding of what impact is now. I think there's a big interest in it. However, people are still getting comfortable with what that means for their returns portfolio. And there's a few system-wide issues, i.e. the rate cycle, et cetera, that are kind of pushing in the wrong direction, which is just cyclical. So the structural undertrend, the long-term undertrend, is really certainly in the right place. And from here out, it's just educating the distributors, so advisors, superannuation funds, etc., to understand what impact is, to be able to put it in their portfolios to ensure that they meet their return benchmarks or their mandates, and for people just to get really comfortable as to the return profile, which may need a longer term investment horizon, or some other factors around it to fit into their current portfolio mandates or personal financial portfolios.
Yeah, that's great. Thank you so much, Claudia. You've set the scene there beautifully in terms of where many investors are, but also some of the challenges. I completely agree with you that the education around impact has improved.